This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Fear factor. Investors are edgy, and it's easy to see why. The election looms, and today brought more hints of a Fed move to raise interest rates soon. What to do with your money now?
Home sweet home. But what might a Clinton or Trump White House mean for the housing market?
Uncertain prognosis. Coloradans will have the chance to vote on an historic initiative, the creation of a universal health care system for the state. Those stories and more tonight on Nightly Business Report for Wednesday, November 2nd.
Good evening, everybody, and welcome. A mood change on Wall Street. Sentiment seems to have shifted in part because of two things: the election just 6 days away and the Federal Reserve. Though the central bank did not move on interest rates today, it may be setting up to do something in the near future. So let's start with the first issue, the race for the White House. Investors are clearly nervous. The S&P 500 fell for the 7th straight day, its longest losing streak in nearly 5 years, as the narrowing race brings more uncertainty, something markets don't like. But given all of the nervousness, a number of Wall Street firms are out with notes telling clients essentially to stay calm. Eamon Javers is following that part of the story for us tonight from Washington. Hi, Eamon.
Yeah, hi, Sue. Look, we've heard a lot, and I mean a lot, from the political pundits so far this year, but maybe there's another group that we should be paying attention to. Forget the political pundits. What are the Wall Street analysts saying about next week's election? Goldman Sachs issued a report this morning saying they still expect Hillary Clinton to win on Tuesday. Polls have tightened, Goldman's analysts wrote, but Clinton still appears to be likely to win more than the 270 electoral votes needed to clinch the White House. Cohen and Company's experts make the same prediction. FBI case dominates national coverage, but Clinton electoral firewall holding with 6 days to go. Those are the expectations baked into Wall Street ahead of Election Day. But think of this as being like the biggest earnings report of all time. The election results will either hit or miss Wall Street's expectations. And we all know what happens when companies miss on Wall Street.
I think the market is saying with Hillary Clinton, we kind of know what we're getting, and we like certainty. And with Donald Trump, I think the market's saying we're not sure what we're going to get. That's uncertainty, and we don't particularly do well with uncertainty.
And Sue, one Wall Street analyst from J.P. Morgan said this week that no matter what happens next week, she doesn't expect that we're going to see a whole lot of legislative progress in Washington because the parties are simply too divided. So that means that no one presidential candidate, whoever wins, will be able to push through much of an extreme legislative agenda.
Yeah, the founders were pretty smart when they gave us 3 branches of government. What do the Wall Street pros say about the direction of the House and the Senate, if anything?
You know, Tyler, their expectation seems to be about the same as the political pundits' expectation, which is that the Democrats have a chance of capturing the Senate, but are likely not to capture the House. And interestingly, they say that if the Democrats sweep, and that is they control the Senate, the House, and the presidency, that might be bad for the stock market, too, because in that case, you could see a scenario where Democrats get to pass all of their own agenda items, and that could be bad, they say, for certain companies in certain sectors.
All right, Eamon, thank you. Eamon Javers in Washington.
So while Wall Street is telling its clients to remain calm ahead of the election, investors are not sitting still. They're hedging their bets with increased demand for safe haven bonds, sending Treasury yields to a 1-week low. And investors are plowing money into another safe haven, gold, which saw prices surpass $1,300 an ounce today.
And economists, who are widely thought to be an unusually cautious lot, are now taking a stand. Hundreds of them have urged Americans not to vote for Donald Trump. In a letter, 370 economists, some of whom have won the Nobel Prize, like Harvard's Oliver Hart and Princeton's Angus Deaton, did not outright endorse Hillary Clinton. Instead, they recommended would-be Trump voters to, quote, choose a different candidate. They argue that Trump has misled Americans on issues like trade, manufacturing, and immigration.
And now to the second issue, the Federal Reserve. The central bank did what many expected it to do. It held interest rates steady, but there were subtle hints that a rate hike may be coming next month. Steve Leisman reports for us tonight from Washington.
The Federal Reserve snapped the rate hike ball at its November meeting and proceeded to punt all the way down the field to the December meeting. That's to say it declined to hike rates in November, choosing to do an end run and steer clear of having any influence on the election. But as expected, it did drop a subtle hint that the rate hike is coming. In its statement today, it said the committee judges that the case for an increase in the federal funds rate has continued to strengthen, but decided for the time being to wait for some further evidence of continued progress towards its objectives. It used almost the same language in September, but it inserted this word some, giving a sense that perhaps the bar is not very high for that December hike. The chance of a Fed rate hike now stands at 69%, up a few points for the December contract, and higher from the November contract, which traded a very small chance of a rate hike. The Fed also noted a bit more inflation, saying in a statement that inflation increased somewhat and removing a line that said inflation is expected to remain low. It otherwise had a similar take on the economy as in September, saying the job market was solid and the economy had picked up from a modest pace of growth. The vote 8-2 with dissents from Loretta Mester from Cleveland and Esther George from Kansas City. Eric Rosengren from Boston, who had dissented at the last meeting, got behind the majority this time to keep rates unchanged. For Nightly Business Report, I'm Steve Leisman in Washington.
So what money moves should you make, if any, if the presidential election has you on edge? Here with us to discuss is John Petrides. He's a portfolio manager with Point View Wealth Management. Let's say I am a little on edge. Is now the time to do something, do nothing?
Yeah, well, what I would urge listeners to do is to look at your overall asset allocation on all of your accounts. How are you positioned in your 401k, your IRA, your tax account, even your checking account? And understand, see how much equity you have, how much fixed income you have, and how much cash you have, and make a decision from there. If you feel like you have way too much equity, maybe 100% of your portfolio, and your time horizon is shorter for retirement, maybe you feel a little concerned there and you want to take some off the table. But to make a decision based on the election here, I probably would not make any decisions at all. Focus on the long term, focus on your overall investment objectives.
And actually, if indeed we do see some market turmoil, if you are a long-term investor, might that not provide opportunity?
Yeah, I think that investors should look in the long term. I think you should be on the balls of your feet, not on the heels. Use Brexit as the latest example, right? We had a 5% sell-off on over a two-day period because expectations were for Brexit to be voted, not to vote for Brexit, and it happened. And then we had this huge rally following. So it was a great buying opportunity if you took advantage of it.
A lot of money has been going into gold.
Yes.
Good move?
Well, I think that's probably a good move to have for more reasons than just the presidential election. I mean, outside of the United States, every central bank globally is trashing their currency to try to stimulate growth. So gold acts as a store of value. So I think having gold as a portion of your overall portfolio makes a lot of sense.
And healthcare is something that you think might act as a little bit of a hedge.
Yeah, I mean, last August of 2015, Hillary Clinton tweeted out about drug price regulation, and healthcare stocks have sold off aggressively since then. And I think valuations are really, really attractive there for the long term. Remember, the long-term objective, we have 10,000 people that are turning 65 every day, and that'll happen for the next 20 years. So the strain on the healthcare system is going to continue. That's not going away. So healthcare stocks for the long term look really attractive.
We always call bonds a safe haven.
Right.
Are they safe now?
Well, just listen to Steve's report before, is that the Fed could raise rates very soon. Possibly the December election. I mean, we have the jobs number coming out on Friday. If another jobs number comes out strong in December, the Fed is running out of excuses here because the data is showing strong growth. So you may pile into bonds now as a protection against the volatility of the stock market for the election, but you could be walking into massive interest rate risk.
All right. John, thank you very much.
Thanks
Appreciate your help. John
Thanks
Petrides with Point View Wealth Management.
On Wall Street, stocks came under some pressure for the reasons that we stated a bit earlier, the Fed and the election. The broader market was also dragged down by a big decline in oil prices. The Dow Jones Industrial Average fell 77 points to 17,959. The Nasdaq was off 48. The S&P 500 was down 13. Oil prices settled down about 3%, a 5-week low on the largest crude stockpile increase on record.
And to the economy now, where private U.S. employers did not add as many new workers as expected last month. According to the payroll processor ADP, companies added 147,000 net new jobs in October. That's the lowest growth level since May. So far this year, private employers have added 175,000 jobs a month on average, a number many economists describe as solid. The government will release its monthly employment report on Friday.
And oh, by the way, there was a big merger today as well. Chipmaker Broadcom has agreed to acquire network gear maker Brocade Communications for $5.5 billion. It's a deal we told you was close to happening, and it's the latest in the rapidly consolidating semiconductor industry. Just last week, Qualcomm agreed to buy NXP Semi for more than $38 billion. Shares of Brocade climbed more than 9%, while Broadcom rose 2%.
Still ahead, what a Clinton or a Trump White House might mean for your most valuable asset, your home. Facebook reported a better than expected quarter thanks to strong mobile advertising sales, and more of the network's users are accessing the site through mobile devices. The company earned $1.09 a share. That was 12 cents better than estimates. Revenue for the quarter rose 55% to $7 billion, but investors had a lukewarm reaction in initial after-hours trading. Julia Borston has more on Facebook's results.
The one key takeaway from Facebook's earnings, the company is continuing to fire on all cylinders, with its advertising business showing consistent growth, which Mark Zuckerberg, Facebook's CEO, says is tied to the company's progress putting video first across its apps. The company beating expectations on the top and bottom line as it maintains user engagement and delivers average revenue of $4.01 per user, reporting more users than expected. 1.79 billion monthly active users and nearly 1.2 billion of them using the service daily, a record addition of daily active users, as the rise of services such as Snapchat doesn't seem to be having much of an impact on Facebook. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And the major insurance companies also reported earnings late today. AIG, MetLife, and Prudential. The results appear mixed as shareholders try to figure out from where the reports where that sector is headed. So Morgan Brennan is here with us this evening. She can do it for us. Good to see you, Morgan, as always.
The bar is high.
Yes. The bar is high, and you've put a lot of faith in me, because just to put this in perspective, AIG alone reports 3 different earnings per share numbers. So it's quite a situation.
Low interest rates have been really a factor that's been depressing the stock prices. Have they moved past that yet or not?
It's a great question, and certainly this low interest rate environment is one we've seen plaguing the insurance sector for years, not so differently than what we've seen with the banks. That being said, the good news in this quarter with these big names, Prudential, MetLife, AIG, the 3 biggest in the sector, what we saw in their earnings is that profit actually grew for the first time in more than a year for each of those names, despite that low interest rate environment, and despite the fact that we're still seeing some issues with some of those products related to interest rates at all of those companies. I'd also just note that MetLife said that it actually saw a 6% increase in investment income for the quarter, and that was actually tied to private equity investments that it's made, as well as some real estate stuff.
My sense is that the insurance companies over time usually do pretty well, one way or another. They're able to price their product pretty well. Was there anything in the quarter, natural disasters, hurricanes and things, that affected them in an adverse and a material way?
Yes. So we've seen a number of hurricanes. Hurricane Matthew doesn't really come till the 4th quarter, so we'll be probably getting some comments on that from conference calls tomorrow. But we did see Hurricane Hermine. We saw that historic flooding in Louisiana. We saw some storms in the Midwest. And so Allstate, which actually also reported after the bell, said that it had seen a big increase in catastrophe losses. And AIG, this is part of the reason AIG stock is actually trading lower after the earnings. They actually saw their catastrophe-related losses in their commercial segment more than double for the quarter.
Oh,
so
wow.
they're a big provider of commercial insurance for property and casualty. So
that's one reason.
Yeah.
Thanks, Morgan. Appreciate it. Morgan Brennan.
Robust box office sales lift results at Time Warner, and that is where we begin tonight's market focus. The media company posted higher than expected profit and revenue because of strength in the film Suicide Squad and higher subscription fees for HBO. The solid results also prompted the company to lift its guidance for the year. Shares were off 1% at 87.28. Alibaba posted profit and sales that easily topped analyst estimates. The Chinese e-commerce giant said an increase in mobile users and strong performance in the company's media and digital entertainment segment helped results there. Still, shares were down more than 2.5% on the day at 98.51. And as for Ford, well, it saw sales fall sharply in October because of weaker demand for models in the company's namesake brand. The automaker was slated to report sales yesterday, but a fire at the company's headquarters in Dearborn delayed results. Shares down 21 cents to $11.40. Slowdown in print advertising sales dented results at the New York Times. The company also said it expects the downward trend in ad sales to continue into the current quarter. Overall, the newspaper publisher saw declines in both revenue and net income. Shares nevertheless up a nickel at $10.95.
YELP posted an unexpected profit and higher sales as the online review company benefited from an increase in mobile web users. But the company did say that the service platform hasn't picked up steam in foreign markets. So as a result, YELP expects to trim about 175 jobs from its global workforce. But YELP was up a big 10% to 35.71. Valeant may be pursuing yet another sale. The Wall Street Journal says the drug maker wants to sell its $2.5 billion eye surgery equipment business. This follows a similar report we told you about last night that the company was in talks to sell its stomach drug division. Shares fell more than 11% to $21.12. Whole Foods posted an increase in profit that beat the street targets, while its higher revenue matched estimates. But the organic grocer did see same-store sales fall more than analysts were expecting. Shares initially rose in after-hours trading following that report, but ended the regular session down 0.5% to 28.51. And Fitbit, which makes fitness tracking devices, said it expects earnings for the fourth quarter to come in sharply below estimates. The company also said substantial spending on promotions caused profit to fall in the most recent quarter. Those results were in line with expectations, but the revenue number missed. Shares initially fell as much as 30% in after hours, and that's on top of the almost 2% drop in regular trading. Shares closing at $12.81.
There's a shift underway, a major one, in the mortgage market, according to Inside Mortgage Finance, which I don't miss. During the third quarter, major financial institutions, banks and S&Ls, accounted for less than half of the mortgage dollars extended to borrowers. That is the first time that has happened in more than 30 years. Non-bank lenders like Quicken Loans and others now dominate the market. The change reflects the banking sector's aversion to taking on mortgage risk.
It is a huge part of the economy, but has been conspicuously absent from the political rhetoric. We're talking about housing. Diana Olick takes a look at how the market would fare under each potential administration.
The housing crash may be over, but the recovery is not. That's why the lack of focus on housing from either candidate is so glaring.
What we've really gotten is more directional conversation. One party talking about affordable housing, the other party talking about deregulating a financial market that seems to have largely seized up.
Neither have mentioned mortgage reform. Fannie Mae, Freddie Mac, the FHA, 95% of the mortgage market is still backed by the government, a relic of the mortgage meltdown. How do we bring private capital back to the marketplace? And how do we manage the growth of non-bank lenders?
Trump is obviously the big unknown in this space, but clearly his whole campaign is about growing the economy and smashing through regulations. So I think that you could see real upside with Trump as well, provided the economy and the other parts of his agenda don't derail everything.
Hillary Clinton also wants to grow the economy, but not at the expense of regulation. She has talked some about affordable housing and underserved communities. There have been proposals from the Clinton camp for down payment assistance programs and incentives for investors to build affordable rental units.
We'd certainly see a lot of support for the CFPB. And it's very likely that Senator Warren will have a big voice in a Clinton administration. And she's been no fan of the banks and certainly a proponent of more and more rigorous reform.
In the end, it all comes down to the economy. Whichever candidate is better at growing jobs and incomes will be better for housing, because those are the main drivers of home ownership. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about housing under either a Clinton or Trump administration, head to our website, nbr.com. Coming up, will Colorado be the first state to adopt a single-payer healthcare system? The measure is on the ballot, but it faces fierce opposition. Health insurer Anthem says it may retreat from its participation in the Affordable Care Act if its financial results don't improve. The company's CEO said this is a critical year to assess whether the insurer continues to participate in the program long term. Anthem's third quarter results fell short of estimates as medical spending increased and other costs rose.
Well, as part of the Affordable Care Act, states can come up with their own health care options, and Colorado is putting to a vote a controversial choice, a single-payer system like those in many foreign countries. Bertha Coombs has details on Amendment 69.
Big deep breath here.
Dr. Ben Vernon thinks the Affordable Care Act is like a Band-Aid on healthcare's gaping wound.
I don't see how the present system has the economics that can support prevention. We haven't figured out if we save $500,000 from a patient having a heart attack, who has that $500,000?
The Denver surgeon is an advocate of Colorado's Amendment 69, which would create the first in the nation single-payer health system, Colorado Care.
When there's one payment authority looking at all of what's happening across the board, we're going to have a much better handle on our providers' quality.
Amendment 69 would fund Colorado Care with a 10% state income tax, with employers paying 2/3 of that tax. Business groups say it would hurt competition here.
Being the only state in the union who would have a system like this makes it very hard for Colorado to compete economically. We'd have the largest income tax and payroll tax in the country, and it hits our smallest businesses the hardest.
The measure made it onto the ballot after advocates raised the money for a signature drive, but Colorado politicians of both parties are also opposed, worried about long-term funding. A Colorado Health Institute study found Colorado Care would break even its first year, but soon rack up deficits without tax increases. Supporters like Irene Aguilar argue the study underestimates the impact of savings.
I think what's important for consumers and everyday voters to look at is how does this compare to what we're doing right now? And overall, that's win-win, even in their assumption.
Even if Amendment 69 fails, Colorado Care advocates say they think they're on the right track, because with the impasse over the Affordable Care Act in Washington, the answer to fixing the problems with health care costs has to come from the states and the local level. Bertha Coombs, Nightly Business Report, Denver, Colorado.
The Justice Department sued DirecTV, alleging that it colluded with rivals to block the television channel owned by the LA Dodgers. The department said DirecTV led the effort to make sure that it and others, including Cox, Charter, and AT&T, which now owns DirecTV, would refuse to carry Sportsnet LA. The lawsuit alleges the companies shared non-public information among themselves to gain bargaining leverage and to reduce the risk that they would lose customers if they decided not to carry the station.
And finally tonight, Silicon Valley is known for many things, but one thing it is not particularly known for is fashion. But at a recent event, some Bay Area designers hit the runway in a very high-tech way. Didi Roy has our story.
Hello and welcome to Silicon Valley Fashion Week.
Welcome to the catwalk in Silicon Valley.
Go drone, work that runway.
Where man and machine meet.
All right, he's got a thumbs up, bring him up.
In a production dubbed Step into the Future, that's part performance art, part acrobatics, and oh yeah, they're also cool clothes. When Silicon Valley holds a fashion show, even the t-shirts are downright electrifying. LED clothes, headpieces, even purses lit up the runway, and human unicorns paid homage to their billion-dollar counterparts. as 500 onlookers gawked and snapped with their smartphones, no doubt tweeting, posting, and Instagramming at the second annual sold-out event. The Bay Area is no stranger to wealth for luxury items. Last year, Silicon Valley had the third highest GDP globally, but the expansion of fashion retailers has lagged compared to the explosion of tech startups. Designers like Alison Lewis played to the crowd by appealing to their hearts.
The heartbeat dress, the wearer wears a heart rate sensor that you can't see, and then the light is underneath and it gently undulates like cascading light that is equal and is in the same rhythm as your heartbeat.
Designers here use these novelty pieces mostly for marketing rather than selling to customers, weaving tech into their fashions and their mindset.
We're very up to date. We use the best processors. We have access to some of the best materials as far as technology is concerned right at our fingertips.
San Francisco-based Beta Brand relies on crowdfunding to decide whether clothing will make its way into production. Each item must reach a financing goal before the designers roll it out, as this high-tech crowd marveled at fashion tech wonders like body marbling. It was clear this night inspired artists and engineers alike. Even though the majority of the designs were just for show, designers here in Silicon Valley have sold their clothes to fashion-forward celebrities like Lady Gaga, Missy Elliott, and Madonna. For Nightly Business Report, I'm Aditi Roy, San Francisco.
I have dibs on the light-up headdress.
Yeah, and the heart monitor, if it stops functioning, you would start to worry, wouldn't you?
I would. All right, that does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll see you back here tomorrow night after Game 7.